Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Welcome, everybody. I'm excited for this topic. I think a lot of people are aware that this is something that I've used to really build kind of a niche out at Alison Wealth Management. It's really how we've grown from zero to over $160 million in the last 4 or 5 years. And so I think that one of the things that really always appealed to me of equity compensation is that it was just such a natural filter of high net worth and high income individuals, people that we'd want to really build an RIA around. I mean, at the end of the day, you don't get awarded or granted equity unless you're a successful contributor to a company. And so I think for anybody else that can embrace this as an opportunity to get in front of executives, it's just a great way to engage from a marketing perspective. And as you'll hear from our guest today, there's just so much incremental value you could bring to somebody to help them navigate their equity compensation. And so I am joined here by two of my colleagues, Greg Dillon. Greg, welcome, and thanks for being here with us. I think most people at C2P know Greg. Greg is a partner over at OneTeam in New Jersey. And then David Roth also is joining us here. David's an advisor at Alison Wealth, and he's been just instrumental in helping me work with our clients over the last, what's it been, David, over 4 years now that you've been part of Alison Wealth. And so he's got a lot of firsthand tactics into the strategies that we implement and how we're talking to our clients. So, Greg, I want to kick things off by just jumping into it with you. We know there's various types of equity compensation. So with some of the bigger public companies, it's mostly restricted stock units or RSUs. With a lot of the private companies, it's either non-qualified stock options or incentive stock options, and in some cases, just private equity grants like profit interests. If you're working with the traditional kind of rank and file employee at most big companies, there's ESPPs. So talk a little bit about how you guide executives through understanding what they actually have and what some of the financial kind of implications or opportunities are with what they have.
Right. Yeah. So happy to be here. So you mentioned depending on where the company is in their life cycle, there's different types of equity that they are either granted or earn over the years. We've really dedicated our business to focusing on specific niches. I'm a big believer in the fact that you really ruin your practice by trying to serve everyone, and we can't be all things to all people. We happen to live in an area of the country, New Jersey, where there's a whole host of pharmaceutical companies. So a lot of our growth over the course of the last few years has come from executives at these publicly traded pharmaceutical companies and trying to help them navigate not only the RSUs that they're receiving, and in some cases the options that they're receiving, but also looking at the broader picture. Where does that fit into their overall financial plan, as well as what are some of the tax planning strategies that they can use in conjunction with some of these tools that they have at their disposal if there's going to be significant income in a year. So looking at donor advised funds for those folks that are charitably inclined to offset some of the taxes that might be due as a result of vesting in certain instances or grants, depending on how things are structured.
Awesome. David, I'll flip it to you. I know you and I have worked together on some huge client cases and dealt with hundreds of millions of dollars of stock options and saved clients millions of dollars of income taxes based on some of the strategies that we've helped them with as they think about how they're going to go from accumulating and having this concentrated wealth to ultimately starting to gain some diversification. What are some key strategies for managing the tax on stock options and equity? And how do we talk to clients about maximizing some of those benefits?
Yeah, and I think that was key, as you said, you're in two phases. You're either in that accumulation or diversification stage. So if you're in the accumulation stage, it's how do you acquire the most options without paying the most tax? So that would be things like mapping out how many ISOs you could exercise in a particular year. And then as far as if you're in the diversification, I think you really have to ask the question, where is it going? What do you want to do with it? And so that's a lot of what we have a conversation. And I'll give an example. We have a couple clients who they're very charitably inclined. And so we might set up something like a donor advised fund or a charitable remainder trust. Others, we've had it where they want to eventually gift it to their kids. So we're doing gifts each year to the kids so that they can eventually sell it at their lower rates. Or it could be just as simple as cherry picking the right stock. If they just want to get out of a position and sell it, a lot of times they'll have stock that's acquired over a decade, and you could find the ones that have the highest basis and sell it with the least tax implications today.
Yeah, definitely. I think that's really important. I mean, one of the things that we've learned, and David will chuckle, like every time we recommend to our clients to sell their Apple stock, as soon as we sell it, Apple goes up like 10%. And so I think it's really the language around how you have these conversations with clients about what their goals and objectives are. The last thing that you want to do is go into an executive or somebody who's accumulated a bunch of stock and stock options and be like, you need to sell all this. You need to diversify. Like, the reality of it is they might be completely comfortable with taking the bet on themselves, the work, their company. They're just not ready to get into that disposition phase yet and diversify. And so I think that that's one thing to just keep an eye out on, is talk to the clients about what their goals and objectives are and what the level of concentration risk that they're comfortable with is. But then when they do get to the point where they want to start to diversify, as David mentioned, it's really becoming very tactical in terms of what their goals and objectives are. I think a couple of the things that we've seen, and we just did this recently, is we had a client that's got a fairly sizable Apple position, $5 or $6 million of vested stock, probably another couple $1 million of unvested stock, getting grants every single year. And we finally got to a point where we mapped out in an Excel file him basically selling at different price targets. So we'd put one into $220 a share, $225, $230, $235, so that he saw it was basically a way of just taking gains as price appreciated. And we'd show what the tax impact would be, the long-term capital gains, the state income tax. And then to David's point, because this client was more charitably inclined, we said, well, there's also another alternative. Instead of paying the government the tax, we could transfer a tranche of these shares into a charitable remainder trust. We could sell and diversify. That charitable remainder trust will pay the two of you an income stream back to help supplement your retirement. But we have to know kind of the growth is going to go to charity at the end of the term of the trust. And they were really into that because they were charitably inclined. And then we talked about doing a wealth replacement strategy with life insurance for the amount that was going to go to the charity. And they loved that as well because it was a win-win. It kept the money in the hands of the family and the charity, and the least amount going to the government from a tax perspective. So I think really kind of diving deep into how they're thinking about this equity and what they're doing. I mean, Greg, how have you seen OneTeam's ability to attract high net worth clients as you guys have evolved your skill and expertise in navigating equity compensation and stock options?
Yeah, I kind of view the equity compensation and the stock options as a subset of the client's overall benefit package. So we've got enough large publicly traded pharmaceutical companies in our backyard where we had a couple of advocates at each of these companies that I have in mind, where they were able to get us the benefits package, not only while they're working, but also their retiree benefits package. So we learned that inside and out. And that basically eliminates the competition because they all have advisors. They all have people that have either sold them stuff or are managing a portion of their money, but nobody's looking at it in totality and nobody's simplifying it with the tools that we have at our disposal, mainly the bucket plan. And I think it's also a subset of the tax management journey. Shameless plug for all the work that Dave Allison's done, but that's been a massive game changer for us. And if anyone on the line has yet to go through the tax management journey, highly recommend it. Having the knowledge, the deep knowledge of a specific client's benefits and their equity comp and exactly how it works For us, also gives us more of an ability to partner with CPAs because we're not doing any of the tax preparation in-house, and there's not a lot of CPAs that specialize in this particular niche. So finding those CPAs that do this kind of work that are on the same level as us when it comes to the knowledge about the specific plan, I think is a good way to build that center of influence relationship. And it also makes for a far easier referral conversation. That we have a sort of a referral tree from this one pharmaceutical company in particular, where we did a lot of this work for a client. They paid us a flat fee to do the financial plan and then ultimately implemented the plan with us. And now when we're asking them, hey, who else do you know that would benefit from the experience that you've had that also has restricted stock, that also is retiring within the next 3 years, that also works for company XYZ, it's a lot easier for them to think of that particular person than if we say, who do you know? Or who can we talk to? So being very targeted in the companies that you're working with. And again, in my opinion, I'm never going to know everything. I don't pretend to know half of what the two other Daves on the call do. But if you can do a deep dive on one or two companies, I think that can change your career, because it only takes a handful of ideal clients from that one company. They're kind of spreading the gospel on your behalf until you have a lot of qualified referrals coming through.
Yeah, exactly. And here's the reality. Like, once you understand how this stuff works, it's pretty much templated at most companies. Like, I mean, David could attest to this. If we have a Meta employee, a Google employee, an Apple employee, and an Amazon employee all come in, like, it's going to structurally work the same way. If we have a client at a startup come in who is just granted a whole bunch of incentive stock options, it's going to be structured the same way, assuming that it's a bigger company. Obviously, like a private startup who's doing more founder shares or profit interests in a partnership, that's where you run into some maybe unique caveats of it. But David, I'll kind of turn it to you. Like, how do you kind of consider equity compensation when you're building a broader financial plan, both to like just project out wealth, income planning, retirement, tax efficiency? Any kind of thoughts or things you want to share of like how you incorporate it into the bucket plan, or even like as we're modeling in e-money, different scenarios for the client?
Yeah, and I think Greg touched on something really important, which is keeping it simple. And I think like there's two parts. One is the modeling that we do, and we do that in e-money. And we map out the stock options, put in the plans. We can map out the vesting and get more analytical there, but then bring it back to the bucket plan and just keep it in those three simple buckets when we're presenting it to the client, because I feel like that makes it a lot simpler and easier to digest. So I think that's kind of the key of integrating it. And then you could start to see, when you have it in that bucket plan, do you have 90% of your net worth in that later bucket in equity compensation, or is it somewhere else? And so just to kind of bring it back to that is kind of how we look at it.
I think the other tool, like the bucket plan, is obviously central to everything that we do. But the other tool that C2P's created that I find hugely valuable in these specific situations is the pyramid of risk. Because I think that although people see on paper how much vested stock they have or how much they have in invested options, when you really put together that pyramid of risk, particularly for the folks that we're working with who are within 5 years of retirement or in retirement, when they see that a large chunk of their net worth is at the top of that pyramid, they tend to be a lot more risk averse than some of the folks that Dave and Dave are working with that may be pre-IPO and have a lot of their compensation in private stock or private stock options. So I think that's another great tool to really simplify it for especially those pre-retiree clients.
Yeah, some of the things that we've done, even with the bucket plan, is, really looking at the unvested stock as well and what the game plan for that is. And like the reality of it is there's pretty much kind of two major options. I'd say three, right? One is it's going to vest. You're going to pay a big chunk in income tax because vesting is an ordinary income recognition event for most RSUs, for example. And you're either going to let that settle into shares, and those shares are going to sit out in your later bucket, or you're going to sell and turn it into cash that you're going to go spend, that's going to go in your now bucket, or we're going to settle into cash and reinvest and diversify. And that could either be your soon or later bucket. And so when we're mapping out a client's bucket plan, we'll put all of those unvested shares in the soon bucket, but we'll put them in like a light gray color because it's not actually any money we could make decisions on today. But we want the client to see, hey, you have $1 million of unvested stock or stock options in your soon bucket. And every vesting period, we need to make a decision on what we're going to do. Is it going to go to cash to supplement your living expenses? Is it going to go to cash to reinvest and diversify? Or is it going to be held in the stock for continued concentration? And I always share concentration could make you rich and diversification keeps you rich. And like that's the reality of company stock. And you need to have those conversations and the trade-offs with these clients of concentration risk. I mean, David, how many clients did we have that in 2021 had a 7 or 8 figure net worth, and then their company stock lost 60 to 70% of its value, and some of them have not recovered yet, but they knew what the risks were and they were smart enough. Like, especially clients that go to work for startups, they're going to a startup to accept concentration risk and try to get rich. Like, that's why they go to a startup. That's instead of going to Apple or Google. And so I think having those conversations of what is the purpose of the equity? How does it fit into your financial plan? How do we mitigate tax on it? I mean, typically at vesting, that's some of the largest windfalls the clients are ever going to have, and is also accompanied by some of the largest tax bills that the client is ever going to have. So I want to flip it over to you, Greg, like looking beyond the immediate benefits of stock options, like how do you help the clients plan for their long-term wealth preservation and growth, like particularly after vesting events or once they've actually now hold the money and it's vested and in their control?
Yeah, I mean, I think it's all about educating them on the risk, like you said. For the folks that we deal with in particular, they tend to be at a stage in life where they've already won the game, and we educate them as we do with everyone on the 3 phases of the money cycle. Many of them are either approaching or should be already in the preservation phase where they're preserving a portion of their assets. And if they're incredibly bullish on the company stock, well, that's fine. That's just a portion of their later bucket. But I think when you walk people through the pyramid of risk and show them where they are today and kind of ask the right questions in terms of what their feelings are about having a significant chunk of their net worth in one company's stock and having their human capital in the same asset that has their financial capital. A lot of folks that we work with, even if they've benefited from the rise in the company stock, they don't want to bet their retirement that stock's going to continue to go up. And you mentioned concentration can make or break people. Well, we've seen both sides of it, and we've actually seen both sides of it with the same client. We mostly deal with folks, again, that are nearing retirement or in retirement. We had one client who was in his 40s, just got a job at a company that did electronic trading of fixed income assets. And it was a publicly traded company, but it was still in its infancy. And part of his compensation when he arrived was restricted stock. And it was at $60 a share at the time. And when some of the stock vested, it was at $600 a share. And in hindsight, you would have held on to all of it. But over time, he was gradually selling out of that stock to move into a diversified portfolio that we managed. And he knew the risks that he was taking either way. But then shortly thereafter, when he received other options and other restricted stock, a lot of the options ended up being worthless because the stock went from 600 to 200 in a short period of time. So again, there's no free lunch, but I think educating the people on the risks involved from a not only from a specific stock standpoint, but also from a strategic standpoint, right? So we had another example where we had a client that really wanted to do the 83B election and was hugely bullish on the company. And shortly after he made that election, he was actually let go. So he paid tax voluntarily on options that he never received, because as part of that election, you have to basically pay tax on options that have yet to vest. So again, educating people that these are the risks from a planning standpoint and putting the ball in their court in terms of their willingness to take on those risks.
And I think what it comes down to is sharing stories like that with clients. I mean, that's such a powerful way to help educate them. I mean, David, we've seen common like mistakes over and over with clients, like where when they finally move over to us and start implementing, they're like, hey, I wish I would have found you guys 3, 4, or 5 years ago. Talk about just what some common mistakes are when managing equity compensation. And then, yeah, I'll kind of just spend the last couple minutes talking about just some things as an advisor you should know if you're dealing with this space.
Yeah, and I think there's two categories of mistakes. One is reporting mistakes, and the other is strategy mistakes. And just to briefly touch on the reporting, we see a lot where they're just not reported right on the tax return, or occasionally the companies aren't reporting. So that's probably one common. But from a more strategic standpoint, a lot of times we'll see something where they won't understand the impact. They just have it set on autopilot. And I'll give you an example. We had a client who I was working with, and he exercised a bunch of ISOs with a company that's pre-IPO, but there was a tender offer and didn't really have an idea of what the impact was and what the valuation of the company was. And it came back that the company value was much higher. So his tax bill that he had to pay was somewhere around $300,000 for stock that he thought he was going to essentially exercise for free. So it can really be these really outsized mistakes that we see. And that's really common. That was an extreme example, but a lot of times we'll see people who they'll exercise and not understand the tax impact of either exercising. Or another really common one is with RSUs. We have clients who are in that very top tax bracket, and they're in the 37% tax bracket, but they're withholding at the 22% tax bracket for their RSUs. So they'll come to us, and especially if it's a first-year client. I had a conversation with somebody once who they told me their income, and off the top of my head, they said, "Oh, I make $300,000 with another $400,000 in equity comp." And I'm like, "Okay, so you underpaid your taxes by $40,000 last year." And he's like, "How did you know that?" And I just knew, because that's the standard withholding. But just understanding that and navigating it so that you look like the expert and can make it so that we can plan around it. It's not a shock when there is a $40,000 tax bill with estimated payments. It really goes a long way with our clients and just, again, smoothing things out.
Well, that's a huge thing. I mean, because the statutory withholding rates on RSUs are 22%, unless they're over $1 million. Then what does it go up to, David? Something a little higher, right?
Yeah, it goes to I think the top tax rate at over $1 million.
Yeah. So clients are in for a painful surprise when they have these vesting events. And so one of the services that we do is help estimate their taxes around vesting and help them just pay the minimum estimated tax payments to avoid any penalties, but have a plan in their now bucket for how they're going to pay this tax bill. So like that's one thing that's a very common mistake with the average rank and file employee, because the benefits departments and HR departments are not educating them on making estimated tax payments. They've been a W-2 withholder forever, and this whole estimated tax payment thing is foreign to them. The other is any clients that have incentive stock options. I wrote an article on this on our website, but there's what's called an ISO sweet spot that you can exercise each and every year without paying any alternative minimum tax. See, the challenge with ISOs is they're preferentially taxed if you exercise them and hold them as a qualifying disposition, which is 1 year from the grant and 2 years, or I'm sorry, 2 years from the grant and 1 year from the exercise. But that exercise intrinsic value can create alternative minimum tax. So a lot of employees don't exercise anything because they don't know how to navigate the alternative minimum tax. And that's a huge costly mistake because they're missing out. Think about like if you didn't convert up to the 12% bracket on Roth conversions each year, you're missing out on those lower brackets. Well, you're missing out on a 0% alternative minimum tax bracket. And so we get a lot of clients that we help navigate AMT strategies and thresholds every single year. In addition, for your clients that have highly concentrated positions, there's really unique strategies to help them manage it. Greg mentioned donor advised funds if they're charitably inclined. There's also charitable remainder trusts, which are incredibly powerful tools to transfer the appreciated stock into and be able to sell and diversify and defer the capital gain. So those are two things to take a look at. There's exchange funds. So at PCA, we're partnered with Goldman Sachs, where for certain clients, they might be able to do a tax-free exchange of their concentrated stock position into becoming a diversified fund partner from a limited partner perspective. And so that's another way high net worth navigate compensation equity. Another one is covered call strategies. So we have many clients that have highly concentrated positions. We're doing one right now for an ESOP rollover. That client has about $2.5 million, and he's got a couple price targets. When it hits $85 a share, he wants to sell. When it hits $90 a share, he wants to sell. When it hits $95, he wants to sell another tranche. And so we're working with Spider Rock, which is on the PCA platform, and they're writing covered calls to generate passive income for him up until the time when those prices hit. Another thing you can do is collared options, where you kind of put some bumpers on each side of what the price could do. So if they're concerned about the price falling and they're willing to give up some of the upside, again, Spider Rock can do a strategy like that. So again, I think helping clients understand that there's options associated with all of, these different kind of strategies, that it's not just sit there and hold on to your stock and let it vest and rest, right? It's that you could actually put some practical strategies in place that could end up saving you a fortune in income tax and help protect what, to Greg's point, you've accumulated at this point. So those are just some strategies. The other thing that you really need to be careful of if you're kind of playing in this playground is if they have any insider trading policies that you need to navigate. Most of our clients are what's deemed to be an access person at a company. Most of these companies have a pre-clear department that if we're going to submit a trade that's not under a 10b5-1 trading plan, in some cases they might need to submit it and get pre-clearance before they can sell. And so you need to have that conversation with your client and say, like, hey, are you subject to trading windows? Can you only buy or sell your stock in a certain window? Are you subject to pre-clear? Are you an access person? Because the last thing you want to do is go and sell a bunch of their company stock, and now they get in big legal trouble from their company, especially if they're a public company and they're an executive. So those are things to take into account, as well as you're just kind of helping your clients navigate all of this. So we're here to help at C2P. Again, I know David, myself, our team, we've got a boatload of experience. We've helped some of our advisors navigate big clients that have come in with stock options and equity compensation. But I would highly recommend, if you're looking for a niche to get involved in, this would be an area to continue to do more professional development and learning on, because it's a huge, huge opportunity to continue to attract high net worth clients that really need advanced planning. And the value you can bring, what David, a couple of years ago, we helped a client with 69-cent stock options sell almost $80 million of company stock over a 2-year time period after Snowflake IPO'd. So there's like an evolution, pre-IPO, post-IPO, big companies, small companies, just so much opportunity in this place. And so I think we are at time, and we appreciate it. Next week's topic, helping clients avoid marginal tax traps. Jeff Warnkin and Seth Meisler are going to be joining. So 2 more tax gurus coming on, different topic, but more along the lines of tax management. So I appreciate everyone's time today. And if you have any questions, just let us know.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit C2PEnterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.